I hear them say your name, and I know you live in me. Let's say Viva, he's a legend, and I'd smile, and my mind would fly. Every day of my life watching you. This is Nagaw, Nibubona Mobele Bak, in Jena way. Viva, you are a legend. Moma indoni nanga pande kwake yini ayingubekwe ngakona ntsikuthi viva ndiyakuthembisa soze sijike masifundise uthando masifundise umhlaba masifundise uhleka wasifundise ukuvana thina wasifundise inyama wathi nyamezelani wasifundise uthando lomculo viva la 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 viva the legend.
Thank you, Zee. Good morning everyone. I am happy to announce it's officially spring. Well, I'm working from home today in Pretoria, so I hope that it's also a fantastic day wherever you are. I also want to just welcome our speakers today. We have a fantastic lineup. We will start with 27-4, who will be talking to us about opportunities outside of listed markets. And that will be followed by 91, mitigating investment risk in South African infrastructure. And then we will close the session around the new regulation 28 guidelines and infrastructure classification. So I am so excited to listen to our speakers. Colleagues, this is something that you will find people discussing, within the industry, wherever you go. But these conversations should also take place within your boardrooms. So thank you very much for investing time to come and learn a little bit more about this. So our first speaker of the day is Rory Ord, 27-4. So Rory, thank you very much. I'm really looking forward listening to your presentation. I will appreciate it if you could, just introduce yourself. We've seen your CV. It's been circulated a little bit about 27-4. And what will happen is there's a Q&A here. So please, as you listen to Rory, post your questions. And I will also give you an opportunity to unmute and ask an in-person question, which if you like. So thank you, Rory. Looking forward to the presentation.
Thanks very much, Anne-Marie, and very good morning to everyone, and thank you for joining us. We're going to be talking about some interesting things this morning, hopefully a little bit out of the norm from what you normally discuss in your investment portfolios, and we think things that are well worth talking about. Anne-Marie, shall I share the slides from my side?
And that will be great. I think it will be easier for you to manage, unless you want us to do so.
No, that's fine. Happy to go ahead. Okay, great. So the interesting thing about investment markets is that they are always changing, ever evolving. That's the case in South Africa and, of course, everywhere around the world. And I think the interesting thing from a regulatory perspective is that regulations need to keep up. And in South Africa, that means Regulation 28, which sets the limits of where different allocations to asset classes can go, have to keep up with the times and what's actually happening in our investment markets and where the opportunities are. And as we know, these things can take a really long time. Regulatory change takes a lot of consultation. You need everyone to put their views in and understand everyone's perspective. So they tend to take a long time, and so they don't happen very often. There was one in the beginning of this year, but the previous time that Regulation 28 had been changed was more than 10 years prior to that. And what's happened each time in these regulatory changes is that the ability for South African retirement funds to invest into unlisted investments, so invest outside of the listed markets, has been opened up each time. So South African retirement funds are getting more and more opportunity with the regulators' blessing to invest outside of the listed markets. And there's some good reasons for this. If we look at the trends over time in the listed space, we can see that there's a lot of decline in listed markets. You might not see it in the headline numbers, but in the number of listed shares, we've certainly seen declines on the JSE over time, as well as in many exchanges around the world. And this has been the case as the unlisted markets have grown, and opportunities for companies to seek funding in the unlisted space has grown. There's been, I guess we see it as more of a rebalancing that's happened between the listed and unlisted space. That's not every company is right to be in the listed markets. The listed markets certainly have their place, and that'll be right for a lot of companies. But even some quite large companies don't really want to be in the public markets and can operate better in the private market space. So this change in the regulation, which has just happened in the beginning of this year, is recognizing this and is allowing retirement funds to invest more outside of the listed markets. So the change that was made was really to allow up to 15% of retirement funds portfolios to go into private equity. The previous position was that there was a category of 15%, which was allowed for private equity and hedge funds together, with a maximum of 10% in either category. I think from the private equity industry point of view, this never really made sense to us, that hedge funds and private equity were grouped together, because they're such different types of investments. Hedge funds are pretty much all in the listed space and an entirely different type of investment strategy. So from the private equity industry side, the commentary that we had from 10 years ago was that private equity should really have its own category. And this was granted by the regulation this time around. So now there's a category where retirement funds can put 15% of their portfolios into private equity. So where can they actually go? Private equity spans a spectrum, right from quite early stage investing, which would include things like SME type of investing, venture capital, high growth type of investments. It would also include what we call mid-market or mid-sized investment in mid-sized companies and large companies that are just below kind of the stage of listed companies, but also infrastructure. So investing in the infrastructure, in the equity of infrastructure projects, would also be classed as private equity. So there's a lot of options, and obviously as 27/4, we've tried to offer different options for retirement funds in the space. And we've seen a lot of evolution in the market in general, where there are now quite good options for retirement funds to kind of diversify their investments and target sort of different parts of the private market space. Whereas in the past, maybe it was options were a bit more limited. And I think this is one of the benefits of the regulatory relaxation, is that it allows kind of the industry to evolve more products and I guess approach the retirement fund industry with more confidence, knowing that there's more capital that can potentially be allocated into this area and into the real South African economy. So one point to highlight is just how many enterprises, business enterprises there are in South Africa, because I think this is often underappreciated. And there are actually around 2 million enterprises operating in the country. Now, most of these are not what would form part of the investable universe, but are more informal enterprises. So maybe 1.5 million or just more than 1.5 million of these enterprises are sort of very small operations which help to put bread on the table for people, but are not really part of the they're very difficult to invest in. Often, maybe 1 or 2 people that work in the enterprise and have very kind of small operations. But as we go up this pyramid from there, the companies become larger and larger, and obviously the number of these companies becomes smaller. You'll see right at the top of this triangle are listed companies. There's a tiny proportion of the companies in South Africa are actually listed. Obviously, these are the largest companies. These are the ones that have turnover in the billions. But below that level, so if we're looking at companies that have a turnover of at least 100 million rands, so these are becoming medium-sized enterprises. There's between that and the listed markets, there's 8,000 to 10,000 companies, which we would regard as the investable universe for private equity. So there's a relatively large number of companies, probably more than people think, to invest in South Africa. And if we include things like venture capital, which are not necessarily at that level yet, then you're starting to be able to invest a little bit further down this triangle as well. So I think the general message is that there's more opportunity than people think, and that small triangle right at the top, the listed space, is only actually offering access or exposure, mostly exposure to the top 40 and perhaps the top 80 companies. And we think that retirement funds should be looking a little bit more broadly than that. So if we think about this in a slightly different way, if we think about the development or the life cycle of a company, how a company might go, all companies start out small by definition. Every company needs to start somewhere. So some of those companies stay very small, so they'll always be SMMEs, small and medium enterprises. But there is a subset of those companies which will grow, and those either grow sort of at a steady pace and grow organically and become sort of mid-sized companies, or they are this kind of the subset of small companies which are very high growth and are exciting high growth companies. And this forms part of the venture capital space. And we'll talk a little bit more about some examples of that to give you a greater flavor for that. But if we think about the areas where we're talking about investing under Regulation 28, it's largely in this mid-market private equity space, into the large private equity space. That's where the bulk of the capital goes. And then increasingly, pension funds are starting to look a little bit below that and to think about, well, how do we invest in the next generation? How do we invest in the exciting things that are being done in the venture space and the high growth space? How is technology in South Africa actually allowing us opportunities there? I'll talk a little bit to that in a minute. So firstly, I just wanted to give you a little bit of context on the global from the global space. So this is something we track over time. This has been an evolution over the last really 2 decades. What this chart is showing is the amount of capital that's actually raised every single year. So each year globally, how much capital is raised just for private investments, so investments outside of the listed space. Obviously, this has been something that's grown tremendously over this time. If we look back to 2003, still a large amount of money was raised, but it was around $100 billion in 2003. To the point now where consistently each year more than $1 trillion is raised to be invested into the private markets globally. So it's a staggering amount of money that's actually going into the space, and you can see how this is broken down. Into many different areas. Just excuse me for 1 second. Let's start here again. Yeah, I think if we look at the detail, if we look at the detail here, if we look at the detail, we can see that the all sort of different categories of private markets investment are getting a lot of investment. Right back in the beginning, I think the classic type of private equity is buyout. That's the type, that's the what people think of as private equity globally. And you can see that still gets a lot of the actual allocations. But the areas of venture capital has grown massively over time, become a huge asset class on its own. And then right through real estate, infrastructure, and different sort of more niche styles of private equity investing. All of them have become quite large on their own. And there's been tremendous growth over time. I think a lot of this growth has been driven, a lot of it has been driven by the initially endowments, university endowments. Those were the ones that initially put capital into the space. But after that, what happened was the retirement funds followed, and that's where the real money came. I think a lot of this happened in the aftermath of the global financial crisis, in the recovery from that space, and the low cost of capital after that space actually drove a huge amount of investment in this area, and really ramped up the fortunes of private markets. Okay, I'm not going to dwell here, just to say that there's been a huge focus on impact, and that's specifically something that we focus on in the space. All of our efforts really around investing in the space are focused on South Africa, and we think there's a lot of opportunities to invest here in the real economy that still make a lot of sense. I know that there's a lot of negativity around the South African market, and I think that a lot of that is very fair. The environment is incredibly difficult. It's not easy for households and for businesses, but at the same time there are still opportunities, and I think we shouldn't be blinded to that fact just because we're struggling in our everyday lives. I think the things that really mitigate that is, first of all, price. A lot of the opportunities in South Africa are much cheaper. It's much cheaper to buy into these companies here than it is in other places. And sometimes, the companies are even really globally linked, or they've got global growth plans. but just because they're started out in South Africa, the opportunity to invest in them comes at a much lower price. So I want to talk to a couple of examples here. I think that will just make it a bit more tangible for the kind of opportunities that exist. And these are all deals that that 274 has done over the last year or so, and just examples of investing in this space. So first of all, with the venture capital side, I think that this is an area that's new for most, if not all, retirement funds in South Africa. There has been almost no retirement fund investment into earlier stage investment, and it's really over the last little while that's the first allocations have started to come, and I think that's a really exciting development, and hopefully excited by these kinds of opportunities and can look at things further. So the first one I want to just touch on is Vitruvian Medical Diagnostics. So Vitruvian and Kenna are both early stage companies. They're both companies that would be classed as venture capital companies. So Vitruvian is a company that is really providing digital access to diagnostic testing in South Africa, where things were previously done in a very probably the way that they were done 30 years ago, or 40 years ago, maybe even 50 years ago. Things had not really changed much. And what I mean by this is if you go to the doctor and the doctor is not sure what's wrong with you, they'll often do a blood test. So Vitruvian has developed an artificial intelligence system to analyze blood samples by using an existing analog microscope that's in most labs around the country. So they've partnered with all of the major laboratories, including the government, to actually offer their platform. And really what it's doing is converting all of those old microscopes, like the ones all of us used at school time to look at what cells look like under a microscope. It's the same thing, but they can actually, because of the add-on that they've created and the platform that they've created, the digital platform, they can actually digitize the entire process of capturing those samples, and in doing so, offer a lot more access. And this means that even if you're in a rural area, you can get access to proper testing that's done. And this same service, although it was started in South Africa, is now being rolled out across the Middle East, and a lot of advancement is being made in Southeast Asia. So this is a hugely exciting company with applications across really the developing world, in all areas where kind of cheap access to high quality testing is needed. On Kenna Health, kind of the idea is also in the medical space. So what Kenna allows anyone to do is to have a doctor's consultation right from their home, without having to travel to a clinic, without having to book an appointment in advance. Within 10 minutes, anyone using the Kenna app on their phone can have a doctor's appointment at a fraction of the cost of going to a clinic. So depending on who the patient sees, the appointment will cost between 120 and 180 Rand instead of 600 Rand plus in most other instances. So it's cheaper and much more convenient, and patients can still get a sick note if they require it. They can still get a prescription for the medication that they need, all quick and easy, and can be done without taking time away from work, and those sorts of things. So incredibly exciting. This app really they only started doing appointments last year, about 9 months ago. The application has already been downloaded almost 300,000 times in South Africa, so it's had huge uptake, and is now being rolled out across some major employers in the country. it's one of those win-win things. So for employers, it gives a lot more uptime, for the employees, a lot less time off work, and it's much cheaper for anyone actually using the service, and much more convenient. So it's a great intervention that's happening in the market, and seemingly getting a lot of uptake. So we're quite excited about that one. On the more mature side are two businesses that we've, like I said, invested in over the last year, alongside other private equity firms. So the first one was QLink, which both of these are kind of in the financial space, both QLink and E4 in the financial space. QLink works with insurers and E4 works with banks. So both of them are integrated into those financial services systems. These are both companies with more than a billion rand of turnover. So they've become fairly large businesses, and they still have plenty of room to grow. But they all provide sort of the digital and the background services, the systems, which make it easier to operate financial systems. So QLink does a lot of collection of policy premiums for insurers. So they integrate into payrolls, they integrate into banking systems, and so they're able to kind of do those collections on behalf of insurers and create and make sure that that collections are actually, that the premiums are actually collected on time, to make sure that insurance is valid. And this is something that's been endorsed quite strongly by National Treasury. And in fact, QLink is the only party that's actually been allowed to integrate into the government's payroll system. Then E4 is quite an interesting one. Kind of the core of their business has been to integrate, is to facilitate the kind of the paper flow, what used to be a paper flow in banking. When you buy a property, there's a lot of documents that are required to flow between the different parties, and they've provided a workflow and documentation record of that previously paper-based process, and they've digitized that for the banks and the conveyancers and all of the lawyers who work on property transactions. So it's you can see that because of the number of transactions, there's lots and lots of property transactions that happen every year, and E4 is integrated into the different banks. That's become a very nice business on its own. So these are just indicators of the types of businesses that are available. There's also, businesses across manufacturing, across healthcare, education, and everything in between. Private equity, like I said, has between 8,000 and 10,000 companies available in the universe in this country. So there's opportunity in just about everything. So it's a very interesting space, and I encourage you to talk to your service providers to understand the space better. So think about it. Think about the kinds of investments that you'd like to have, the kind of spaces you'd like to be in, and then you'll talk with your consultants or the right parties. That's taken us to the end of the presentation. I will hand back. I'll hand back to Anne-Marie to hand on to the next speaker. Thank you.
Thank you so much, Rory. But before we do that, there's some time for us to, ask questions. I think if we can just take down the presentation, and then or maybe what I can do is so that I can see some hands on my side. Great. So just an invitation again to everybody that's online. If you are, there you go. If you have a question or a comment, please post that in the question and answer box, or you can also raise your hand, and MP will make sure that they unmute you. Rory, just by starting, while everybody is thinking about what they want to ask you, is I think there's an issue where you indicated that, you know, there's a capital raising is happening. I think your slide indicate that even globally, like 46% into infrastructure, which I thought it's quite significant. My question is, you know, we raise this money, but do you have a sense of what gets actually deployed? Because maybe I need a little bit of education about open and closed funds. And it seems as though there's a lot of, fundraising happening, but what is the ability to really deploy, and what does the pipeline actually looks like in this particular instance? Maybe you can talk to us about, you know, specifically in South Africa.
Sure, it's a great question. So yeah, you mentioned closed-ended funds. So most of the private markets funds, so private equity and venture capital, and even most of the infrastructure funds are fixed life funds. They're called closed-ended or fixed life funds. So they'll typically be a 10 or a 12 or a 15-year fund. And sometimes they describe it as say a 10 plus 1 plus 1 fund, which, you know, is a 10-year fund, which allows for 2 extension periods of a year each. That's the kind of the language that's used. But in every closed-ended fund, there's an allowance initially for an investment period and then a realization period. So there's normally in a 10-year fund, the manager of the fund would normally be allowed 5 years to invest the capital that's committed to the fund, and then they have the following 5 years to actually exit those investments. If they haven't exited them, that's where you get to the +1+1 type of situation where there's extensions to allow them to exit. But the question you're asking is around the deployment. So what happens within that 5 years? Like, are the managers actually managing to deploy this money?
Yes.
And this is something that really that people really need to pay attention to when choosing their fund managers. So when choosing a particular private equity fund manager, you have to get a lot of confidence that the manager has got a strong pipeline of deals to do. One of the things that people don't like about the private market space is that you often get a J-curve. So, and that's the reason. A J-curve is when you get a dip in your performance initially before performance kind of recovers, and then you get some upticks in performance. But that's not great for pension funds. And in our portfolios, that's something we specifically trying to address. That's something we're trying to always avoid. But the main reason for having that J-curve is the weight of the fees that come up front. When there's no pipeline, when there's not investments made, a large volume of investments made early on, then the J-curve is much worse. So assessing that pipeline of deals is critical. And in our own fund of funds portfolios, I mean, this is what we really make sure of. And we actually contract with the managers that we use in our fund of funds portfolio to make sure that we put deadlines in place where they have to have made certain investments by. Otherwise, there's penalties on fees. So we regard it as extremely serious, because if you don't actually have the deals, why should the commitment fee be there?
Yeah, exactly. So I think this is maybe just a follow-up on that one, and I see that we have two questions in our Q&A. So what are some of the exit strategies available for retirement funds? Once you're in there, how do you deal with that?
Yeah, so exit is exit on a deal level. So when we're talking about exiting a company, an investment in a company, that would be done by the private equity fund manager. So the private equity fund manager would make the investment, and then they would eventually sell the investment, and then they would return the capital to the retirement fund. So that's a kind of a built-in exit mechanism. But it still means that the the manager has to find the exit. So normally exits are done either through sales of the companies to, they call it trade sales, and about 2/3 of the exits go into trade sales, which means that if you've got a shoemaking company, you sell it to another shoemaking company. So it's a strategic type of sale to another party. And then the other third mostly goes to other financial buyers. So you might find that you sell the company to another private equity firm or an investment holding company, something like that. There's a lot of exits that happen through that channel. Otherwise, for specifically to what retirement funds can do if they need to exit, there is a little bit of what they call a secondary market. So if you have a stake in a private equity fund, you can actually sell that stake in a private equity fund to another party with the consent of the manager. You do need the consent of the manager, but they don't, as long as the buyer is of good standing, that wouldn't be declined. So retirement funds can actually do that, and it's not something that's often used in South Africa. But I think if more retirement funds were interested in selling, there would be more of a market.
And I assume, obviously, these are the kind of things that you will have information about upfront. So it should not be a surprise at the end of the process when you say, oh, but maybe I've made a mistake. So Regulation 28 allows 15%, but private equity has liquidity challenges. So what are the allocations that funds are making towards private equity? And what are the allocation funds are making towards venture capital? Maybe with more buyers and sellers, the liquidity constraint can be overcome. So maybe just a comment on that.
Yeah, so that's right. I think so the kind of initial retirement funds adopters of these kinds of investments were initially the parastatal funds, so the larger funds. They could allocate a relatively small part of their portfolio. This was back when Reg 28, didn't even have a category for private equity. Those were the early adopters, and they would still manage to allocate. They would still manage to allocate some of their portfolio, and they would find kind of innovative ways of getting exposure to this part of the market. But these percentages have grown over time. Some funds are actually at their limits. Some funds have gone over their limits in the past and are now back in because of the regulatory change. But I think it really varies according to the size of the funds. The larger funds, and even some of the more sophisticated funds have gone for these kinds of investments, and have kind of upped their allocations and done it in a way that they're comfortable with. I think a lot of the smaller funds haven't really looked at this at all yet. So there isn't a kind of a blanket rule across the board.
Yeah. And then I also think, around the venture capital, I've made a little note here, Rory, that how do we really overcome this sort of risk issues there? Because there are good opportunities, but it seems as though retirement funds are, so wary to really look at it. Is it an issue of myth, or should we investigate a little bit more, or is it a real issue, the fact that there's such a, like you said, the wide spectrum of early stage, that long before they really get to the place where retirement funds feel comfortable to invest?
Yeah, I think what people must understand about this space is that it's not the same as choosing a listed equity manager and choosing these types of allocations. There's a much higher dispersion of returns between the best managers and the poorest managers. You've got a really big difference between the highest performing and the worst performing. Whereas if you're choosing, say, an SA listed equity manager, you're going to have, maybe slightly, you're going to have allocations either side of a benchmark. You're going to kind of hug a benchmark to a certain extent. There's not going to be a massive variation. But if you choose if you choose well in the private market space, you should do very well. If you choose badly, you'll do badly. So there's that risk. So we see. I see there's another question in the comments or in the question Q&A about how retirement funds should really access this. And I think particularly for the smaller retirement funds, I mean, going the fund of funds route is a much better option. The thought that retirement funds can choose well in this space is, I think we have to be very careful about that.
Yeah, and that is for the smaller funds, obviously. And then I think there's a follow-up that given the
if you don't know what you select, if you don't know what you're selecting for, it's very
Now, given that PE plays a role in the direct economy of South Africa,
so should the industry not collaborate? Yes, I mean I think it would make a difference. There's a funding gap in this country, a huge funding gap. Our banks are quite conservative. They will lend into the corporate sector, and to some extent, they lend into mid-sized companies and provide certain things to smaller companies. But there are definitely some funding gaps. People looking for equity investment. There's far too many people looking for equity investment in companies than there is equity investment to go around. We don't have enough capital, and that's where the growth in the country can actually come from, is through investing in the companies that kind of make up the economy. We mustn't forget that in the listed space, I mean, most of the emphasis of those companies is offshore. And so we can't just sit here complaining about South Africa all the time when we don't invest in it ourselves. And so, we've got this channel, we've got this private equity industry, which knows what to look for in good companies, knows how to invest in them in a way that manages the risk. And so I think we have to use it. But from the retirement funds point of view, we need to do it in a way that diversifies risk. So you want to have a large portfolio. You need to find a way to have a well-diversified portfolio within the private markets allocation. And that's where the fund of funds direction comes in. People think fund of funds is a dirty word, but it's really a way to control your risk, and a way also for smaller funds to still make allocations into the space. And I can tell you, I mean, from our perspective, in our flagship fund of funds, which started 5 years ago, we've achieved a net return of 17% annually for that period. So it's definitely possible to make good returns over a difficult period, as long as you're doing things well.
Then there's another follow-up question, and I think this is the one that we're going to wrap up on, Rory, is that, the companies that you describe is quite niche. So what steps do you take in your due diligence processes to limit the risk of fraud, and especially in these specialist companies where the technology is still new and possible untested or proven? I think people have been, hurt in the past.
Yeah, and I think maybe what the question is coming from is there's an example of a company like this in the US, and there's a Netflix documentary about it. Theranos, it's in the question. So absolutely, you have to be wary of these things. So one of the key steps for those sorts of investments for us, in particularly where it's technology based, so we included technology due diligence as part of our steps. So along with the financial, the tax, all of those areas of due diligence, we included technology diligence. But the bigger thing that gives us comfort is that we won't invest unless we see the industry, so the informed insiders in the industry, actually taking up the service. So what gave us, I think the question here is about the company Vitruvian, which operates in this medical diagnostic space. So when we could see that they were getting uptake from Pathcare, from Ampath, from Lancet, from NHLS, the government laboratories, when everyone wanted to work with them, and then we spoke with those parties directly and asked them about the results of those trials, and how they were working together, it's very, very difficult, if not impossible, to kind of fool the experts across all of those different reference enterprises. So investing where you're actually seeing that particular sector experts putting their money does help a lot and does reduce the risk.
Right. So we have a final question here as well, which is so nice that, you know, the conversation is coming alive, Rory. But maybe just a quick final note to say, you know, there are certain pitfalls that appear, you know, when you very late, 10 or 14 years after investment. This is in respect of African PE investments. Is there anything that comes to mind that you will say, oh, be on the lookout for this or that, and just make sure that you maybe look into it earlier rather than later?
Yeah, so I think, Anne-Marie, you mentioned the point earlier around what you know up front.
Yeah.
And this is incredibly important. So the way that contracting works for investment in private market funds is everything is specified by contract. These are not investments that sit within, at least not yet, they don't sit within the collective investment schemes legislation. So there's often not kind of standardized legislated ways of operating. Everything is actually set out in contract. And so understanding that well, understanding what your rights are as an investor is a key mitigation. And understanding, you know, particularly to this point around exit and what happens really if you're not getting the exit. You know, you need to have rights as investors. You need to be able to work together with other investors, and you need options. So, you know, your fund contracts should give you the ability to cut off fees for the manager. It should give you the ability to fire the manager. It should, you know, you should be able to, you know, make the necessary interventions that you need to look after and monitor your investment. You know, I think you know, there are definitely cases where, you know, poor contracting is in place and doesn't give investors a lot of options. And I think a lot of the time that's only recognized way down the line when, you know, when this type of situation occurs. So it's very important to understand that contracting and to work with advisors that understand what rights you actually have.
Right. So thank you very much, Rory, for engaging session, and for all our delegates who are so actively participating. We are going now to our next session. Thank you so much. And I would like to introduce our next speaker. Let me just get the great Sine Zulu. She is going to talk to us about mitigating investment risk in South Africa infrastructure. And Sine, thank you very much. You're from 91. I think, you know, our conversation so far, you know, is a good opening for what you will be sharing with us. So thank you very much. We are looking forward to your presentation.
Thank you very much, Anna-Marie. I'm going to go ahead and just share my presentation with everyone. Okay.
There you go. Thank you very much.
There we go. Can everybody see my screen?
Yes, you're welcome to continue.
Okay, awesome. So good morning, everyone. I hope that this is going to be an enjoyable session. I'm quite passionate about infrastructure because of its importance to our economy and because of the way it positively and tangibly changes people's lives. And I hope that by the end of this session, my enthusiasm for the subject matter has rubbed off on at least one of you, and that I've shed some light in the way that we look at investment risks and infrastructure investments. There's quite a lot to get through, so let's get into it. To kick off this session, we've outlined here what we believe are the biggest investor concerns from an infrastructure investment perspective. And my aim for this presentation is to hopefully be able to address these concerns and discuss some of the mitigating factors. We often get a lot of feedback from the pension fund community that there's just not enough projects that can be banked by the private sector. The sector requires too much capital and there are too many things that can go wrong. These are long-term investments and we will struggle to raise cash quickly. There's too much government interference and policies, and the regulatory landscape just isn't certain. And there just aren't enough professionals that are skilled or experienced enough to invest in this very complex asset class. So, as a poll question, I would love to hear your perspectives into what you believe is the biggest risks that you are concerned about regarding infrastructure investment. And I'm going to ask the team from Batseta to please share the first poll question that we've prepared. So if you can just select one answer from the list of options that are there. Is it a lack of skills? Is it liquidity that you're concerned about? Is it an insufficient pipeline of projects? Is it the financial risks, or is it the fact that government tends to interfere too much in these types of projects? Anne-Marie, are we getting some answers coming through?
Yes, we are. So let's just give it another 10 seconds.
Another 10 seconds, okay. Oh, wow. Okay, so we've got the answers there on the screen. Can everybody see the answers?
Yes, we can.
Okay, so it seems like, yeah, there's quite an even spread, but it looks like option E, government involvement, is one of the biggest concerns that the pension fund industry has. Okay, so hopefully I'll be able to address that concern as we go through the presentation. We've also prepared a second poll question, which relates to the state of our infrastructure. And I would love to hear from all our participants what they think the best rated infrastructure is in our country. And this was a study that was done by the Southern African Institute of Civil Engineering, and they produced basically a scorecard where they rated the various pieces of infrastructure. So according to you, what is the best rated infrastructure in South Africa? There's only one correct answer in this list. Is it our universities? Is it our national roads? Is it our telecoms infrastructure? Is it the Gautrain? Or do you think it's our airports, which are managed by AXA? Okay, so the responses are displayed on the screen. Also quite a fairly even spread. 30% of you think it's the Gautrain, 26% is our airports, universities, national roads are tied, 18%, and then our telecoms are 15%. Okay, we'll get to answering that question in a little bit. But thank you very much, Bendulo. I think, okay, to just kick off, from our perspective, we've been investing in infrastructure across our various strategies for a very long time. In fact, over the past 20 years, we've invested about 58 billion Rand at an average rate of deployment of 7 billion Rand per year. And we've supported over 130 borrowers and projects. So far from what we've seen, pipeline hasn't been a huge challenge to us yet. We have 26 credit investment specialists, of which 15 are dedicated to infrastructure. So we don't have a lack of talent issue. And in terms of ESG, ESG analysis is quite an integral part of our credit process, and we take it quite seriously. So on a case-by-case basis, we're able to engage quite closely with our borrowers, and we drive and encourage positive change where we're able to. And where we are today, we've got assets under management of just over 100 billion rand, and of which infrastructure accounts for between 40 to 50% of all our general debt strategies. So that's where we are as 91 as a business. And then to answer that second poll question on the best rated piece of infrastructure in South Africa, here we have the answer. The South African Institute of Civil Engineers, or SAIS, they conducted a study on the state of infrastructure in SA across all industries, and they produced quite an interesting and quite a detailed report card, which grades our infrastructure from A through to E, A being world-class, B being fit for the future, C being satisfactory for now, D being at risk of failure, and E being unfit for purpose. The scorecard also uses plus or minus symbols, which suggest the score is either robust or fragile when that piece of infrastructure is operating at peak pressure. The only piece of infrastructure that majority of you actually got right is that we have that was world-class is actually the Gautrain. We do have a few others that are not in too bad of shape, being rated B, which is our national roads, the airports being the AXA facilities, our heavy haul freight on our rail, the electricity transmission lines, as well as the digital infrastructure. Sanitation outside of urban areas is not fit for purpose. Our provincial and municipal roads that are not paved are not fit for purpose. And PRAS, I mean, you see lots of media reports, certainly not fit for purpose. We do acknowledge that, there are pockets of excellence here and there, but overall, our infrastructure is rated a D. So that's why we've highlighted that orange block in bold. Most of it is actually at risk of failure. And so what this implies is that there's a lot of investments that is needed, and there's a lot of work that needs to be done to fix it. So I don't think we need to look very far for pipeline. It's just a matter of first we need to just fix what we have, and that we can consider as low-hanging fruit. And to fix our infrastructure, the government, alongside the private sector through the Sustainable Infrastructure Development Symposium, they've prioritized a huge pipeline of infrastructure projects in the transport and logistics, water, sanitation, energy, human settlements, as well as the digital communications infrastructure segments. These are projects that are going to require funding outside of the fiscus, which is on top of the public infrastructure spend of 903 billion rand that is planned over the 2023 medium-term expenditure framework. A lot of these projects that are listed here are brownfields expansion and maintenance projects, such as the ones that we have listed in the water sector, and others such as the ones in the ICT segment are very likely going to be private sector led, as has been the case so far with the build out of all the data centers and laying all of the fiber infrastructure and all the telecommunications towers that we have. So it's all very promising. There's a massive pipeline, and this tells the story of the potential that exists in our country. And I don't think there's a doubt in anyone's mind of the government's commitment to try and develop and to fix the infrastructure issues and the infrastructure challenges that we have. So where do we lose infrastructure projects, and how come we don't see enough of them coming to our desks? So we know that there's money available, there's a huge pipeline, and there's a very clear need to fix our infrastructure. So why are we struggling to bank these projects? So there's a study that was done by McKinsey, which shows that most infrastructure projects on our continent fail to reach financial close. Although the stats that I've got on the slide represent the whole continent, I believe that similar could be said about South Africa, given the state of our infrastructure. The study concluded that 80% of all projects fail at the business or feasibility or business plan stage. And then we have another 50% dropping off before financial close because either they're not viable or they're just not enough funds that are being spent on developing and preparing the project and allocating the risks and packaging the projects in such a way that all the risks are sufficiently mitigated. But the flip side of the coin, I would say, is that the projects that do end up coming across our desks as private investors, have been prepared and they are already packaged, and a lot of the risks that have been thought about and have been mitigated. And I think that's where the private sector can play a more of a role. If we focus more on the projects that have been fully developed, then it goes some way into relieving pressure of the government so that they can focus on earlier stage projects and then developing them so that they can be packaged better and then ready for private sector investment. And if we split the development of a project into its three main stages, the first stage is the preparation or development stage. Here at this point, the project developer or the shareholder appoints external experts to conduct technical feasibility studies, environmental and social studies. They apply for permits and license, and they also are quite busy securing land, etc., on which the project is going to be constructed on. This is typically funded through public sector using grants or equity. And at this stage, we believe that it's too risky for private credit funds such as ours, the ones that we manage at 91, or pension fund money. And so we typically would not get involved at this point, because this is where a lot of projects fall off. Stage 2 is the construction stage. Once all the licensing and all the permitting is done and all the studies are complete and there's confirmation that the project is viable, then construction can start. And it's typically carried out by a specialist firm like an engineering, procurement, and construction contractor. This phase, it's easier here to attract funding from various sources, both public and private, using various instruments from bank loans right through to private credit and private debt, etc. Even equity also gets involved at this point because the project has been significantly de-risked. During the operations phase, there's even further de-risking that happens. At this point, another operating company can come in. They take over to manage all the operations and the maintenance of the project. The risk profile is quite different from the first two phases. And that's where I think the private sector or private credit or private equity can play more of a role because of the de-risking that I just mentioned, having been through the project preparation and construction phases. So the risks at this point are much better understood. And yeah, like I said, at this point is where you would find the private sector playing a much bigger role. So yeah, I mean, each stage carries, I guess, a very different cash flow risk profile. During the preparation stage, the project developers are spending a lot of money applying for licenses, securing land, contracts, etc., and conducting various studies. So they're spending a lot of money on contractors trying to prepare the project so that it reaches a point where it's fundable. And then during construction, the cash flows go deeper into negative territory because CapEx is being spent, and hopefully all the money is then recovered during operations, and if the project is able to perform according to plans. So I've already explained that during the preparation and development stage, the project sponsors have to carry out various technical and ENS studies. And so they need to acquire licenses, permits, etc. And these are quite costly exercises because of the specialist firms that need to be appointed to do these. And at this point, the sponsors don't know if the project is going to be able to raise the necessary funding. So the development risk falls entirely on the project sponsors, and it's their experience and the expertise that can help in mitigating some of these risks. Next, when the project enters the construction phase, there are three main risks that we've outlined here. First is the delay risk. Will the project be built on time? If the project is delayed, then it has several contractual repercussions. For example, the project won't be able to deliver into power purchase agreements or other offtake agreements on time, and then there are penalties for this. So it's quite a big risk that needs to be properly managed. And these delay risks are usually dealt with in the EPC contract, where the contractor will have to pay penalties to the project company for each day that the project is delayed. The penalties are usually equal to the cost that the project incurs, including the cost of lost opportunities. So if the project, for example, needs to start repaying interest on its debt, then the delay penalties that would be incurred by the EPC contractor are passed through to the lenders. So in project finance, we always check for pass-through mechanisms mechanisms in the contractual arrangements that serve as lender protections. In terms of completion risk, will the project be completed on time? Again, this is also dealt with in the EPC contract, where the EPC contractor provides a completion guarantee. And normally we have these guarantees backed by an independent bank outside of the financing process. And then lastly, technical performance risk. The project needs to be able to perform as agreed to in the EPC contract, or else it's not going to be able to generate the forecasted cash flows to repay the debt and also to service dividends. So it's normal to have performance guarantees in the EPC contract. Otherwise, any shortfalls in performance are also penalized. And so once the project is operational and operations start, there are other risks that arise. Revenue risks, for example, will the market buy the produce that is produced by the project at a certain price? And how you manage the revenue risk depends on what service or what product the infrastructure is producing. We typically favor infrastructure projects with strong off-takers that are buying the output at a pre-agreed price or quantity. We view what is called take or pay contracts quite favorably, because there's no way that the off-takers can back out of those contracts. Where there are multiple off-takers, for example, in the case of a toll road, where pedestrians are going through a toll road, or trucks are going through a toll road, you have a lot of market risk. And here, the revenue risk can be mitigated through government guarantees to cover the debt repayments and the other fixed costs of the project. So government guarantees like this, you typically see if the project is being developed through a concession agreement between the sponsors and the government. And then you also have supply risk during operations. This is the risk of supply of raw materials. This is typically managed through supply contracts, where suppliers agree to supply raw materials at a certain quantity and a certain price over a fixed period. And they also agree to pay for any alternative sources of supply if they can't perform. So the suppliers in this instance are the ones that take the risk. And you can typically see this in agricultural processing or manufacturing, or in the case of power plants that use gas as a fuel. And then also during operations, we've got the O&M contractor, the operations and maintenance contractor, that's responsible for the O&M of the project, and they assume the operational risk. If the project doesn't perform as agreed to in the O&M contract, or is not maintained accordingly, then performance penalties are levied to the contractor, which are then also passed through to the lenders, and they cover the debt repayments in the case of if the project is financed using a long-term debt. And then there's also inflation risk, which is passed through to the off-take of the buyer. As an example, we see toll fees on a toll road that are increased annually, and these are passed through to the users. Electricity tariffs, also another example, they increase almost annually. They're also passed through to the off-takers. And then political risks, such as expropriation or civil unrest or civil disobedience or change in law. These are usually dealt with through government guarantees, export credit agencies, or insurance. You would have seen some of the infrastructure getting destroyed during the July unrest that we had 2 years ago. We always make sure that projects are adequately insured, and that those insurance policies are then ceded to us as lenders. So if there's a political event and our infrastructure gets destroyed, the proceeds of that insurance are normally paid to the lenders. So that's a general overview of all the risks that I could identify during the various stages of an infrastructure project. And so if we can put all of these risks together and analyze them in a matrix, which it shows which party is taking which risk, this is quite an easy way to see that if a project is properly structured, then each risk can be properly managed. Just as a general rule of thumb, each risk is allocated to the party that is most capable of managing it. And going across the top of the table, you can see the type of risk. And on the left-hand side, you can see the party to whom the risk has been allocated. So for example, the construction risk is mostly taken by the EPC contractor. The revenue risk is mostly taken by the off-takers. Political risk there's political risk, mostly taken by host governments, ECA agencies, if there's an ECA cover on the financing, and insurance will also take some of the risks if there's adequate insurance that is been put in place. So in a perfect world, projects would never fail because of this risk allocation, but sometimes you do have weak sponsors, you do have weak EPC contractors or weak off-takers. And so sometimes projects can fail despite adequate risk allocation. And this is why due diligence in projects takes so long, because there are so many parties and there's so many contractors involved, and each of them need to be analyzed appropriately for their strengths and the capacities to develop and operate projects and also fulfill on their contractual obligations. If there's a weak sponsor, this is our view, if there's a weak sponsor who doesn't have sufficient technical or financial capacity, we walk away. If the EPC contractor is not experienced enough to take on the technical risks, we walk away. So we tend to be quite selective in choosing the infrastructure companies that we finance, because we have a duty to invest responsibly. But having said that, we think that triple Ps are quite important for the economy. They're a proven way to drive private sector investment into infrastructure. They're quite, we find them quite appealing because they allow governments to develop public sector assets while at the same time avoiding large upfront capital spending through off-balance sheet financing. And the second reason why they're appealing is because they lighten the burden on the fiscus, while at the same time relying on the private sector's expertise and experience to drive these infrastructure projects. And there's been some really good examples of triple Ps that are functioning thus far in our country. First, we have the Renewable Energy Independent Power Producers Program, or REAP. This program has attracted, I believe, just over 190 billion rand in investment, most of it from the private sector in the form of debt from the banks and the institutional community. And it has added over 6,200 megawatts of cleaner energy to our grid to address all our peak power demands. The national toll roads, these are concessions with the government of South Africa over 30 years, where the private sector has been responsible for maintaining and operating the roads for a fixed period. We've got the N3 toll roads, we've got the N1 as well as the N4 toll roads with the Bakwena concessions. And then you've also got the ROMCO pipelines. They are responsible for importing gas from Mozambique into South Africa, and they provide feed and raw materials for Sasol's industrial processes. This is also another great example of a triple P. It's a JV between the government of South Africa, the government of Mozambique, as well as Sasol. And so, yeah, this is a great example of a triple P in the oil and gas sector. And the last example that we've included here, there are others, but the last example we've included at this point is the Gautrain, which is a concession agreement between Bombela. And you would have seen in my earlier slide how it's one of the best maintained pieces of infrastructure in the country. So, triple Ps aren't perfect. Sometimes they can be a little bit controversial, but they are a proven way to really get the private sector involved while at the same time reducing the financing burden of the government. So here, I want to spend a little bit of time just talking about governance risks and government involvement in infrastructure and our approach as 91 to investing in such entities that are viewed as vulnerable from a governance perspective. In the poll question earlier, we saw that majority of you were concerned about government interference in these big infrastructure projects. So if we broadly split the infrastructure investment landscape into two, first you have the public sector, which is mostly dominated by the monopolistic entities that need to be regulated and they need to be government controlled because, they're monopolies and the interests of consumers need to be protected. So you've got the likes of Sunroll, Transnet, TCTA, Randwater, as well as Eskom in there. And then secondly, you have a more competitive market where regulation has really opened up the market to new entrants, and the private sector can really go in and create its own pipeline of projects because it's less regulated and is not monopolistic in nature. We've seen this predominantly in the telecom space, where we as 91 have provided financing to very strong sponsor-backed companies like Vumatel, Dark Fiber Africa, IHS Towers, Taraco and Liquid. And then there's others on this page like MTN and Vodacom that are not included. So there's a whole thriving sector of telecommunications companies in SA that is funded by the private sector. And most of these instruments or these funding instruments have been led through the banks. And so we partner up with the banks to access these opportunities and create our own pipeline. In the electricity generation space here, we've got the REAP program, as I mentioned, that's also provided us the opportunity to invest in generation companies. And, the government has really helped here by lifting the generation caps. And that's really driven the proliferation of private power generation in this country. So we've got a lot of, IPPs that have come through, and that's really provided an opportunity for the private sector to directly fund into the electricity sector in South Africa. I mean, Eskom, there's a lot of talk about unbundling Eskom into generation, transmission, and as well as distribution. So we see the transmission lines as well as the distributed energy part of Eskom still being very much the responsibility of Eskom, but we see more and more the private sector generating their own power and creating more of an opportunity for us as private investors to play a bigger role. In terms of social infrastructure, yeah, I mean, like healthcare, as well as real estate, that's also opened up opportunities for the private sector to get involved. I mean, we've been involved with companies such as Life Healthcare, as well as Bowen, who have had a real impact, across the economic segments of South Africa. I mean, they provide high quality, affordable housing to the middle income sector in SA. So very good case studies there. So yeah, in the private sector, we typically, like I said earlier, we've been investing in the really strong, experienced sponsors, and we fund them directly using private debt. As I said, yeah, we originate, the opportunities with the banks by partnering up with the banks. They usually have pre-existing relationships with these companies. So, these opportunities are generally not that difficult to find. So pipeline in the competitive markets isn't a big concern for us. In the public sector, we typically invest in the SOEs through listed bonds, which give us liquidity in our portfolios. We typically pick the SOEs where we have a very strong conviction that the government will step in if things go wrong. So we invest in the bonds that are guaranteed by the South African government. We believe that it's our belief that the SOEs are very important for our economy and for many other industries. Everything is just so interlinked. We can't generate electricity without water. We can't run our railways without electricity. So for the sake of our country and our economy, we believe that we can't just step away because of the governance risks that are elevated on our SOEs. And so, we've picked the likes of Eskom, Transnet, Randwater because we have a high conviction that the government won't let them fail, and we use our investments as an opportunity to stay involved, to engage where possible, and to try and advocate for change. So that's been our approach when investing in the SOEs that are a bit more sensitive to governance risks. And then on the question of liquidity, we know very, very well that this is a very important question in the minds of our clients. And I believe that there are industry-wide initiatives to come up with innovative solutions to offer more liquidity and infrastructure investment. However, we are credit fund managers, and we have found debt to be an attractive alternative for investors at a project level, because if you look at how a typical infrastructure project or company is funded, you'll find that most of the funding mix, in fact, 60 to 80% of the funding mix is through debt, which presents a very big opportunity sets for funding projects. And debt funding can be either through loans or in the private markets or through bonds. And the advantage here is that these are self-liquidating instruments. In other words, you've got scheduled interest payments, you've got scheduled principal repayments from the borrowers to us as lenders. So liquidity risk is manageable. We find it is manageable compared to mezzanine equity, even though the returns are not as high as mezzanine equity. So on a project level, we think that we can introduce liquidity into our portfolios using debt. That being said, we do believe that equity has a very important role to play because it's a booster of returns for any portfolio, and but for the purposes of liquidity, we think that debt is quite attractive. And then, a second layer of liquidity is then managed at a portfolio level through more liquid instruments like the bonds that I mentioned earlier. If you invest X% of your portfolio into bonds, such as those issued by the SOEs, you can then introduce more liquidity into your portfolios. So, overall, we have several lines of defense in infrastructure investments through the various stages of the investment process, from screening right through to post-close and portfolio management. At the screening stage, we tend to be quite selective about our investments. We use screening criteria that includes the infrastructure segment. So we prefer renewable energy, telecoms, etc., sectors where we can have a real impact and we can prove impact. Project stage plays quite a big role. We tend to shy away from projects that are earlier stage. They need to have passed all the tests of viability with our sponsors. And then we also look at the potential returns, as well as the regulatory environment of the specific sector. Is the regulations enabling for the development of such projects? Is it supportive? And then if it passes through our screening criteria, then we go into due diligence. If it's a project financing transaction, we have the option of appointing specialist firms that help us with the separate due diligence work streams. At this point, any big red flags are usually discovered, and then it gives us the option to reject some deals. So our due diligence focuses on the legal aspects, the contracts, the permits, etc., the technical aspects of the project, if it's a very technical power plant, for example, the ESG, insurance, tax, as well as the commercial and market due diligence options. There are definitely going to be risks that will be highlighted during the due diligence phase, and we usually mitigate these through very careful structuring. We spoke a lot earlier about risk allocation, and then finally, post-investment infrastructure requires very close monitoring so that any changes to the risk profile can then be caught early and then managed appropriately. And so finally, infrastructure investments, I just want to close off by saying that infrastructure investment is not as risky as it's perceived to be. And this is seen through a study that was published by Moody's, which showed just how low the defaults are in African infrastructure compared to other geographies. These stats are continent-wide, so they're not South Africa specific. I guess the conclusion here is that, the perceptions of risk aren't a true reflection of reality. Our default rates on a cumulative 10-year basis were 1.9% compared to the other more developed nations. I think this is quite low. So I think for me, these low default rates demonstrate how effective the risk mitigation instruments and measures that we've been through in this presentation really work. You will still have risks that you can structure for and mitigate against, but I think that overall, the risk levels in infrastructure investments are not as high as they're perceived to be if they're adequately managed. Thank you.
All right, thank you, Sine. I must be quite honest, I have been educated today. It is really so clear, the processes in the way that you have unpacked it. So I see that there are quite a number of comments and issues raised here. So I'm just going to basically, the first one that I want to talk about is if you can maybe just stop sharing the presentation, so that I will appreciate that, so that I can also see hands and so on. There you go. So I think the issue here is, we inevitably have to work with government. This is something that collaboration will be required if you really want to impact South Africa. So, this whole issue around mistrust talk to us a little bit about that. You know, what is the real sense and feeling around that? Because it's inevitable we will have to work together. And I see that, you know, you have the SOEs and that it's important, and that you have a sense that government won't make them fail. Yeah, so just talk to us a little bit about, you know, how can we improve that situation where government just maybe go on a drive, like it said here, to get the trust back.
Yeah, we get this question quite a lot, Anne-Marie. It's a tough one. And as you rightly point out, we have no choice but to work with the government. We need to collaborate quite closely with them if we are to fix the infrastructure conundrum that we are facing. I think, you know, from our perspective, I think I highlighted a little bit earlier that, you know, we view the SOEs in particular. I mean, I also mentioned earlier that those are the ones that are more vulnerable to, I don't want to use the word corruption, but governance. They're the ones that are more sensitive to governance issues. And so, you know, our view is that they are important to the economy, so we can't just walk away. They are very important to our economic growth. I mean, our economy has been stagnating for a very long time, and so they are very important to our economy, and we simply can't just walk away and say, oh no, the governance risks are too elevated, we can't do anything about it. So our approach has been to you know, evaluate all the SOEs on a case-by-case basis. So we know which ones are very core to the economy, like Eskom, Transnet, as well as Rand Water. Those are quite interlinked. And so we've chosen to stay involved in those, but invest in the more liquid instruments, like the listed bonds that are guaranteed by the government. So from a credit perspective, it's not as bad. Compared to the unlisted, ungovernment guarantee, not the ones that are not guaranteed by government. So from a credit perspective, first it needs to make sense. Then the second layer is to remain engaged. So we have ongoing conversations with, you know, the management of all these, the executive management of all these SOEs. We engage with them quite regularly, quite frequently. And, you know, I think there's a growing sense that, you know, they acknowledge that it needs to be fixed. They acknowledge that things tend to go wrong, and it generally feels like a lot of work is being done to root out all the governance issues that tend to be persisting in the SOEs. So, you know, we engage quite often with them. Our approach has not to walk away, but rather to stay engaged, stay involved as the private sector, so that we can try and effect change where we can, but only on a case-by-case basis where it makes sense from a credit perspective. Yeah.
So I see that, you know, there's a long question with a long issue on the chat box, where, you know, Richard says that 115 CEOs of top companies have signed a pledge to assist government with the initiative in fixing several problems. Have you signed it? I think that's one of the questions. And then, you know, I think you've answered that you are working with the SOEs and so on to get, you know, going and to make sure that you have your finger on the pulse. Should there not be an industry-wide mobilization to renewable energy infrastructure on generation and distribution, given the SAICE rates? And yeah, then at risk or failure, does 91 have an independent power producing investment initiatives? How many of those has been mobilized and then maybe involved in the REAP? How are retirement funds involved in that, or in the main form of investment private bonds with companies? But I think, you know, it's a lot of things that is in this note. But I think, you know, try to summarize is that, okay, maybe you can ask whether you have signed that pledge or not.
I believe we have.
Yeah.
I stand to be corrected. I think Megan, you are. Can Megan answer the question? I believe we have signed up to that. I don't want to make the mistake of saying something wrong, but I believe we have signed up to that pledge.
Yeah. So, but I think the crux of this question is also, you know, Sine, we know our problems. We know we need electricity, water, sanitation. We are quite aware of it. you know, and I think from Batseta side, we've established the Asset Owners Forum so that, you know, we get together as retirement funds and mobilize.
Yeah.
But, you know, what is missing in this whole conversation for me, and maybe I want to hear your view, is that we haven't found that project. You know, how do we know that there's the list of the government projects that are in various stages of, you know, becoming bankable. But how do we mobilize as an industry where we say, as South Africans, as the retirement fund industry, as our service providers in this industry, how do all of us come together and say to government, we want this project or this project or this project, and let us make it work? You know, it still feels that everybody is sort of doing their own thing and looking at their own pool of investments, but that sort of collective mobilization is not happening.
I
Or am
agree.
I wrong?
Oh, now I agree with you to a certain extent. I think that a lot of work has been done by pension funds and the asset owners to allocate and to invest in infrastructure. And the question here from Richard, the one that you just read out, talks a lot about REAP. REAP, I think I mentioned the number earlier, about 190 billion has been invested in REAP, in the renewable energy project, through from bid 1 up until, I think, bid window 4. It's about 190 billion that's been invested in there. And a lot of it, admittedly, has come from the banks, but a lot of it has also come from the private equity funds that are managed by the institutions. We as 91 are starting to see, I mean, we've struggled previously a lot because of the returns. The returns are just, there's so much demand and so much money flowing into the renewable energy space. And so the margins are a little bit compressed. So we've struggled a little bit with the returns, but we've made our first few investments into the renewable energy space now, because we're coming up with more creative solutions, working together with the banks to structure around, find structures that, enhance the return profile of the renewable energy investments. And you said, how can we work together with government to deploy more into the sector? You know, we saw about 2 years ago now, the government lifting the generation caps of the application for the self-generation licenses. And that has meant that a lot of the heavy energy users, like the mining companies, like the manufacturing companies, are coming up with their own power solutions. So we're seeing a lot of companies building their own power plants, like the solar rooftop. The solar rooftop industry is really, really thriving right now, and a lot of money is going into that sector. So that's a great example of where the government and the private sector are working together, where the government is making it easy for sponsors like the mining companies to develop and build their own projects, so that the private sector can come in when the projects have been de-risked a bit more. So I think, the REAP example is a great one where we are working together. I mean, the SOEs for us, I think because they are mature companies, I think the investment opportunity there is going to lie in the listed bond space for at least the short to medium term.
I see that we have a bit of a overrun, but I'm still going to just ask this. It's so important. I see that I know you're speaking from a credit fund point of view. However, most of the financing requested from asset owners and pension funds is equity. So we don't enjoy the same protections and liquidity guarantees as yourselves. How then would you propose that the equity players mitigate these risks, and where should you say is the optimum time for them to come in the project stages?
Yeah, I mean, I think I'm a big proponent of borrowing from project finance principles. I mean, project finance has a lot of structuring, and there's a lot of due diligence that goes in. I mean, I believe private equity already does a lot of their own due diligence, but the depth and the depth that project finance goes into due diligence is quite amazing to see. I mean, we appoint external advisors that are quite experienced and are quite competent and quite specialist in the various levels, like legal, insurance, technical, ENS, etc. I believe that private equity can borrow from some of that, but it's a very difficult question to answer.
Yeah.
But I
Right.
think, yeah,
No, thank you. You've done quite well. And then I see that Sifiso Nala has his hand up. He just wants to ask you a question, and then we'll wrap up. Sifiso,
No, I'm fine, thanks. I did get answered through the slides.
oh, that is excellent.
Thank you so much.
Thanks,
Thank you.
Sifiso. Right. So thank you, Sine, for the excellent presentation, and once again to all our delegates for your participation.
thank you.
Right. So now we're getting to our last conversation, and we are going to discuss Regulation 28, its guidelines and limits that came into effect. And here we have Riscura that's going to help us with this presentation. And I think it's also, an excellent way to end the conversations. It's Bilkiz Dawood that will take us through Reg 28. And I think I have already a few questions lined up, but thank you very much. We are looking forward to your presentation.
Thank you, Anne-Marie. Just having a look, I don't see the picture being shown. Just give me. Can everyone see me? Hello?
Not at the moment.
Let me just see what happened to the picture.
We can just see your screensaver.
Should I just continue with the presentation so long until the video comes up, because my video is on?
Yeah, that's perfectly fine. You can go ahead and share your screen. That should be perfect. There you go. We can see your screen.
Okay, just. Okay, so apologies for the camera. My video is on. I'm just not sure what happened at the moment. I'm Bilkis Down, and I'm from Riscura, and I'll be taking you through the Regulation 28 amendments, which came into effect this year, as well as how we interpret classifying infrastructure classifications. Before we start, I'm just going to ask Batseta to release the first poll questions. Okay, so the first question is, Regulation 28 protects members of retirement funds by making sure that, and there's just a few options to choose from. Have the answers come through yet?
Yeah, we just want to give it another 30 seconds.
Okay. And we see that 90% have answered correctly. I will be covering more of the new amendments to the limits further on. Can Batseta release the next poll question? One of the main changes to the regulation was, and then there's A, B, C, and D. Okay, let's just wait a few seconds for the answers. Okay, so there's a bit of, looks like 47%. I'll cover answered correctly. I'll go through that on the next slide as well. Can we release the last poll question? Okay, waiting for this to come in. False, yes, so 79% answered correctly. Okay, thanks for all that participated in the poll questions. Let's continue with the presentation. So in terms of the Regulation 28 amendments, which were introduced at the beginning of January, one of the main changes to the regulation was the introduction of infrastructure, the definition with a limit set at 45%. Infrastructure, in terms of reporting, it's not seen as a separate or new asset class, and I'll cover these requirements in a bit more detail later. Another change is that pension funds may not invest in crypto assets, and this is in line with the Regulation 28 in terms of protecting its members against investment risk. As we all know, that cryptocurrency is quite volatile and quite risky. Hedge funds, private equity funds, and other assets were seen as a collective asset class. This was also mentioned by Rory in his presentation. It is in the new amendments, it's now seen as three separate asset classes, with hedge funds remaining at 10%. However, private equity has increased from 10% to 15%, and other assets also remain at 2.5%. There's been a change to the definition of hedge funds, and this is now in line with the definition provided by the Collective Investment Schemes Control Act, and it also includes foreign hedge funds. There has been a reduction in the housing loans limit from 95% to 65%, and the purpose of this is to curb the abuse of housing loan schemes by fund members. In terms of overarching limits, there has been a limit which has been introduced on a single issuer exposure, and this limit has been set at 25%, and this applies to across all asset classes. However, it excludes, with the exception of debt instruments issued by the government or loans to the government or guaranteed by the government. The aggregate exposure to unlisted equity and property, private equity, hedge funds, and other assets. So that's the aggregate exposure. That limit has increased from 35 to 45%. So even though infrastructure is at 45%, and that's across all asset classes, the unlisted aggregate exposure is also 45%. So cognizance needs to be taken into account when investors are investing in unlisted. And then in terms of unlisted equity and private equity, that aggregate limit is set, has increased from 15% to 20%. In terms of the definition of infrastructure outlined in Regulation 28, is any asset that has or operates with a primary objective of developing, constructing, and or maintaining physical assets and technology structures and systems for the provision of utilities, services, or facilities for the economy, business, or the public. This definition is quite wide and includes both private and public sector investment. In terms of the interpretation, Riscura has adopted a narrow interpretation in determining what to include within this category of infrastructure. We have spoken with several other market participants and believe that this is the best approach at this stage until further FSCA guidance is released. We are aware that some companies may have broader definitions, particularly with regards to social infrastructure, and we are open to amendments on our part should the industry consensus or further regulatory guidance dictate that it's necessary to do so. For each asset, we made our determination based on the issuer. If the issuer's primary objective meets our interpretation of the definition of infrastructure, then any asset relating to the issuer will be classified as infrastructure. As part of the process, we looked at African and domestic issuers, the industry classification of companies to determine their primary objective. In terms of the definition in Regulation 28, it refers to an asset's primary objective, which we at Riscura mean to take that the issuer must generate at least 50% of its revenue from an activity which falls within one of the predetermined infrastructure categories which we have identified. In terms of exclusions, I'm just going to cover what we have excluded from what we classify as infrastructure. So any entity whose primary objective is for the provision of education, healthcare, or prison, or other social infrastructure related services are excluded. The focus on service provision means that these entities do not meet the definition which emphasizes the use of the word physical assets or technology structures. In terms of in terms of telecommunications, so in terms of mobile service companies, entities whose primary revenue generating activity is derived from the provision of mobile services do not fall within this telecommunications infrastructure category. However, these companies, they often play a role in the development, construction, and maintenance of telecommunications infrastructure. Such activities are not the primary objective of these companies. In terms of property, retail centers, offices, and parking lots, we've not considered as infrastructure. Ideally, after the completion of the property development, often the cash flows to be received from the rental income from the lease spaces to the businesses or public. We've also not included mines in the definition of infrastructure. Their primary objective is to sell resources or commodities. However, even though coal is an essential part of in the life cycle of mining, we've not considered coal as infrastructure. And then in terms of land, as land is also not a physical asset, it's not developed or constructed or maintained for the purposes. Therefore, we've not included land within the definition as well. In terms of, I'm just going to go to the next slide. As mentioned earlier, the limit is set to 45% across all asset classes. And the purpose of this is to enable a longer term investment into infrastructure to assist with economic development. Therefore, private sector collaboration is essential to this. Most pension fund members do plan to retire in South Africa, and investment into this will increase resilience and sustainability of their communities. And as our first speaker, Rory, mentioned, it also allows the industry to have more products and more capital into this area to allow investment. In terms of the reporting requirements, pension funds will now need to report on the top 20 infrastructure holdings, as well as report on exposure per asset class in terms of rand value and percentage. On the next slide, this is just a snapshot in terms of how the disclosure looks in terms of table 2, the infrastructure exposure across the different asset classes. And then on the right is just a snapshot in terms of what we at Riscura have in terms of our database on a specific client in terms of our top 20 holdings, which we have displayed on the right. That takes us to the end of the presentation. Thank you, everyone.
Yeah, thank you so much for the presentation. Let me just see whether we have any questions in the chat box. Great. Any questions from our delegates? I think maybe from my side, when we look at Regulation 28, and I know we also talk about infrastructure and so on, and if we also then look at the issue around taking money out, the offshore investments. So there's a 45% there, and then, infrastructure overall. So if we also then invest in infrastructure in Africa or elsewhere, I'm not 100% sure, how do you make that calculation? A lot of money will leave South Africa while we rather want to keep it inside. I don't know whether you have a comment around that. Does it make sense, to have the 245%? And yeah, then, you invest elsewhere and not in South Africa.
Yeah, thanks, Anna-Marie, for that. Yes, I think in terms of the fund structure, in terms of the investing, managers or trustees, as well as the asset consultants, would need to look at the fund in terms of what they want to invest in. Like the new rule for 45% is offshore, but do they want to go offshore as well, where we would like to make investments into infrastructure within South Africa, as well as I mentioned earlier, most of our pension funds, most of our members will retire in South Africa. The limit is set to 45%. However, it includes Africa and domestic within that. So there is an option. They don't have to be aggressive in terms of reaching that 45% limit. So I haven't seen most retirement funds or pension funds actually reaching that aggressive part of the 45% limit. However, in terms of infrastructure, currently it's still quite thin, where the highest I've seen an average of between 6 and 8% across the funds which Riscura services.
Right, thanks. So do you anticipate for cryptocurrency to develop into a safe asset class in the near future?
Maybe just maybe just as a I don't sorry, as a disclaimer, maybe just put a disclaimer first. So yeah, so I'm not an investment consultant, so I can't provide advice on that. So just in terms of cryptocurrency, and I think the regulation probably needed to make a call in terms of, as it's being asset class, which lots of individual consumers are investing in terms of, as it takes on, it's quite risky and volatile. So in terms of the return on that, we, in terms of regulation, we are trying to protect its members against any investment risk. So therefore, I don't think the regulation would change that in the near to medium term. Its view in allowing cryptocurrency, but in terms of if it's going to become a safe for investing in cryptocurrency in the future, I think it just depends on the individual's, their risk appetite as well.
Right. So I think there's a clarification required about the exclusion of healthcare. You know, because there's obviously the building of the hospitals, and then there's the occupants of the hospitals, you know, the doctors and all the other things. So yeah, so does the building of the hospital fall into your health care exclusion bracket?
No. So just in terms of, in terms of the definition, so the development, constructing, or maintenance of the hospital, that falls within the definition of infrastructure. However, where the doctors and providing the service, that's excluded, but the construction or the hospital, that forms part of the definition of infrastructure.
Right. Coming back to the 45% offshore limits, can that be all invested in Africa? You know, is Africa offshore? Or shall I say Pan Africa offshore?
So in terms of the 45% limit, it used to be, previously it was collapsed between foreign and Africa. However, it's now one combined rule, foreign. So it can put the 45% in Africa or foreign. It just depends on what the way you would like to invest.
So you can actually use any of the allocations then if you wish to invest in Africa.
Yes.
Great. Another question that I think we don't talk too much about, you know, what happens when you exceed these limits? When, you know, you maybe do a miscalculation, or there's a market movement, or whatever the case may be. So what are the implications for retirement funds when that happens?
Yeah, so if there is a
breach of limit.
Yeah. So if there is a breach of limit, and that has been caused by investment into a certain asset class, that is typically a trading breach and needs to be corrected immediately. The fund needs to have needs to address in terms of what they're going to do to overcome this breach, and they do. So trading breach needs to be corrected immediately. However, if there was a breach in terms of market movements, the fund does have 12 months to rectify this breach. In terms of that, the foreign limit, which had increased to 45% previously, a foreign limit was much lower, and there was always breaches on that, and money would always need to be repatriated from offshore into domestic just to fix that breach. Anna Marie, I think you're on mute.
Any other questions? Sorry, thank you. Any other questions, comments, colleagues? Another question from my side, maybe while our delegates are thinking, is, you know, transformation becomes very important in South Africa, and I'm not sure how Regulation 28 actually deals with that, because, you know, including ESG considerations actually translated now into a part of a retirement fund fiduciary duty to make sure that you integrate ESG. What is your view around reference to transformation? And I'm talking here specifically transformation in terms of triple BEE. What is your view around that? And is it now also, can it be seen as a fiduciary duty in the same way than ESG integration? Or, yeah, what is your view on
That's quite a good question. Can maybe just give me a few minutes just to think about it. Could you maybe just rephrase the last part of your question in terms of, you mentioned you're on mute?
Mute again. When we talk about fiduciary duty, you know, through Regulation 28, it became quite an important fiduciary duty for retirement fund trustees to make sure that they integrate ESG into the decision-making processes. So, you know, another very important aspect of that is obviously the transformation that we are experiencing, or that we need to take into consideration. So my question is, you know, to what extent do you think that this is also an important part of the ESG, but maybe an extra T in terms of a fiduciary duty?
Okay, well, in terms of that, there isn't anything in terms of precedent that says that BE or transformation is part of a fiduciary duty, as far as I understand. But BEE could be considered as part of a social aspect of ESG in the South African context.
Yeah, I think what I'm driving at, and I see there's a hand from Rory, I think what I'm driving at, you know, when we look at ESG integration and so on, there are maybe more to it than meets the eye. But Rory, I saw your hand. Please, if you want to add.
Yeah, thanks, Anne-Marie. I think that this is an area of investing where a lot can be done in transformation right across the private markets. So it's somewhere where trustees can really see some impact in the transformation area. So I think across some pension fund portfolios, there's a drive to include Black service providers, and a lot has been done in the asset management side of things, and using Black private equity fund managers and other private markets managers. But the additional opportunity that there is in the private markets is really to extend that down into the portfolio companies. I mean, this is something that we do in every single one of our investments through the funds that we back. We actually contract for transformation plans to be put into place in portfolio companies, so that much greater transformation is actually achieved in the real economy. So not just at an asset manager level where relatively few individuals work and have ownership, but at a much greater level right across, you know, whether it's infrastructure investments where you're at a project level, or companies in the private equity space. You can actually contract and set out a plan for the holding period, which is normally around, say, 5 years. You can work out a good, solid transformation plan over that period of time, where you can leave the company by the time of exit in a much, much stronger place, and can achieve quite a lot for transformation. Thanks,
Yeah.
Anne-Marie.
So thank you so much, Rory. So if there's, I don't know whether there's any additional comments, questions. Thank you so much, Bilgis, for your insightful presentation. I think there's still a lot that we need to do about, really get the definition of infrastructure right. And in this respect, the IRFA and Batseta, we are sort of, also working together to see whether we cannot, streamline that definition. But there is at least, some criteria and processes in place in terms of how to make sure that we stay within that. And obviously, the reporting, I think the FSCA indicated that we're not going to report immediately, but that is for next year. But the fact is, I'm happy to see that Riscura also already have, for some of the clients, that list together. But there's still a lot for us to learn about this. But thank you so much for everyone who participated today. I have learned a lot. And this is not the last word on Bilgis on Regulation 28. There's still much to come, much to learn. So thank you very much for that. Before I close, Bianca, are there any announcements that you would like to share with our delegates before we close?
Yes, and Mary, thank you for that. Bay, if you could please share the screen. We do have our charity day taking place this coming Friday. We have very limited seats left. If you could, if you're in Johannesburg, please come and support us. It's our first charity day. It's a high tea where we'll be donating some funds for a children's home that is located here in Johannesburg. Our next webinar will also take place on the 21st of September, where we will tackle the issues around the FSTC Notice 1 of 2023. More information will be shared through the newsletter. Thank you, Anne-Marie, and thank you to everyone who joined today's session.
Yes, and then the last issue, Bianca, is we will have infrastructure training on the 18th and 19th of October. And more information, that will be an in-person event, but more information will be shared around that. And that will be exclusively for principal officers and trustees only. It will be a closed session, but we will communicate a little bit more about that. So thank you very, very much. Dr. Dunzo, I see that you are online, and I know that you have a lot of initiatives that you are working on into Africa. I don't know whether, you can just maybe for 2 minutes just share with us what you are busy with at the moment. I know that I have not prepared you for this. Otherwise, we can share more information offline. Right. So I will call him again, and he's busy with a lot of initiatives that in Pan Africa around infrastructure. It is important that we have information available across in South Africa as well as elsewhere, but we will call him back and have a conversation. So have a fantastic day, and we'll see you on the 21st of September. Thank you so much.
Thanks, everyone.